Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we're going to talk about 4 things of doom and what they're going to do to this market as we progress through 2024. You're not going to want to miss this one, so let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Use promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
All right, Bob, the doom party is back. So what are these, can you walk us through these things that really, I think, joking aside, though, I think are really going to start to weigh on things in the back half of this year?
Yeah, I mean, our normal listeners are probably shocked to find us a little bit pessimistic here. But reason why I was interested in this is less on what's going to happen like next week, next month, next quarter. Because I think the die is cast. We're slipping into a recession. The government is spending as much as they possibly can to keep that from sliding into a depression. They'll ultimately fail. But I'm looking out because a lot of people are saying, oh, we'll just V-dip this thing and we'll come back out. But we're having a secular change. And if you guys will spare me a quick monologue, the baby boomers kind of control everything. And, I'm the back half of the baby boomer. Phil's a young puppy. Are you a Gen Z, Phil? I forget.
Gen X.
Gen X. So we have a situation here where we're the bulge of the snake. And when I was growing up, they were building high schools like crazy. Then they were building out universities. Then they were. It was hard to get a job because there was so much competition. You had to really fight for things. And then retirement homes started coming into being. Well, now we're at the end of it now, where that boom is on, and the echo boom is still not there. And I think it's only like 60 or 70% of the baby boom. And we have this window now where the baby boomers are going to be drawing out their assets to basically live out their final days. And we don't have enough people to absorb that at the current price because incomes aren't making aren't falling along. So we put 4 charts together to show you guys, like, hey, if you guys think this thing's just going to come bouncing right back once it starts to fall, I think you're sadly mistaken. And the first one here, which is really shocking, is wages have fallen relative to the economy, and it's not necessarily what you think. It's not like wages are necessarily falling. It's just that less people are working for a wage, So, people are getting their price increases. They're not as much as the inflation rate, which is a different problem. But look, when I quit work and I don't draw a wage from my company anymore, I'm living off of other sources of my assets, dividends, drawing down my assets. That's what this is showing here. The other thing, too, is that benefits are taking up a bigger portion of what they would call the take-home pay, if you will. Just because you make $20 an hour, I don't pay $20 an hour to employees, okay? That's getting up to like $35, $38 an hour, depending on what industry you're in, because you're paying back half of the employer taxes, you're paying benefit costs, you're paying workers' comp claims, et cetera, et cetera, et cetera. And the employee take-home money is becoming less and less and less because those things keep overwhelming employers' ability to pay people. So wages are going out, and then you have a situation where the stock market looks great because the next chart here that Phil just brought up is the stock market is all about money supply. So when everybody tells you it's this, that, or the other, we've shown you this before, is that stock market only goes up if we're pushing more money into the system. It can never outpace the GDP, outpace the money supply. So as the money supply starts to get out of whack here and is starting to tighten and fall, stock market will follow it at some point. And I think right now they're making it up through a lot of derivative trades, which are unsustainable in the long term. But back to our economy for a second, you're looking at the bankruptcy filing. So wages are going down, companies are going out. This one is concerning. I think we have to watch this, Phil, because this looks like a cup and handle of bankrupt filings to me. We look at too many charts.
Yeah.
And this thing's going to probably push up to that gray area again. And I think a lot of people are really, really weak in their balance sheets. And we talked about this before, the S&P 500. I think over 20% of the companies can't cash flow, Phil. They have to keep borrowing, and they're borrowing now at higher rates. At some point, they're going to have to relent one way, shape, or form, either through change their balance sheet structure, which will hurt stock prices, cut labor and cost, maybe cut their revenue, or just go into survival mode, which all is going to hurt the stock market. But these bankrupt filings are affecting small and middle income businesses now, and it's just going to smoke up the chain here as less and less people have the ability to pay their bills. And I think we have one more chart, if I'm not mistaken, and this is the one that kind of kicked me off, is that we have the year-over-year change in the U.S. population. Okay, it's actually, we're going close to a negative rate. And these are the people that are supposed to keep lifting up. Remember, we're a debt-based economic system. So unless more people can take on debt, have the ability to absorb the debt payments, that's going to affect money supply. Because a lot of people don't realize money supply is more than just the dollar in your pocket. It's the loans that are created. And that's the big thing. It's part of our economic illiteracy that we have out there. People don't understand it. If Phil and I tomorrow decided not to pay our mortgages, okay, and they have to be defaulted upon and expunged in bankruptcy, if you will, then you have a situation where the money supply fell by what we defaulted on. People don't understand that. And so you have a situation now where I think we're at peak credit, Phil. Nobody else to come on board. These 5 million, 6 million people are letting into the country through this illegal immigration population growth program we got going on. They can't absorb a lot of debt. So I don't know how that's going to be helpful to the economy. Otherwise, it's just going to be drawing and dragging out. So I think we're in big trouble here, not just short term, Phil, but medium to long term. The next 20 years is going to be pretty scary, I think.
Yeah, you have to really go back to the turn of the 20th century, right? When we had this situation with the U.S. population. So we've gone many generations now without running into this. So this is a game changer for sure. And if you go back to the Great Depression, even, I mean, look how long it took to really come out of that funk. And we're at much lower levels now on the year-over-year change in the U.S. population. So it is a big problem. Population growth for the long term for a country is hugely important. That's why Japan is utterly screwed here, because they haven't had enough births to keep up, and now they've got a massive aging population. It's effectively baby boomers on steroids with nobody behind to take the place of it. So they're going to need a lot of immigration to sustain their economy. Otherwise, they're in for a world of hurt over the next probably decade plus and beyond. That's a huge problem. I think is misunderstood and mispriced here. So yeah, we're in uncharted territory. What does that mean for the markets? I think we're in a different market now. I think a different era of markets. But at some point, we've gone through these leveraging events before. We've seen it in almost every bubble. If we go back to the money supply chart, I think it's very clear that we're over our skis again. And I think this time even worse than we've seen before. If you look at the bearishness that we got in 2000 to 2001 and the great financial crisis from like 08 to 09. I mean, if you look at what happened, we got pretty good moves away from the mean line of money supply. And then we had a pullback. This time, I'll point to COVID too. You could say, well, 18, 19, those years, we got away from the mean. But, 20 came along. And again, I think it was more than just COVID. I think that ran cover for a lot of stuff, because I think the banks were on the precipice of a massive implosion. I think we just had cover for COVID and lock everything down, let the banks reset, print a bunch of money, and nobody will know the difference, right? Well, that caused a bunch of inflation. So I think that was kind of a hideous plan really to once again bail out the banks at the public's expense. Now here we are again, except this time now money supply is actually accelerating to the downside. We've shown that chart before. The rate of change in M2 money supply is at historically negative levels, more so than even in the Great Depression. So we're going to get a snap back down here, right? It's just a matter of when. Did we just put in the high here, and this bearish window that we usually get into March really kicks off a larger top that plays out through the rest of the year? It's possible. It's also possible you can get one more final squeeze too, but I don't think this is sustainable through this year because of just where we're at with all the various different things. And, now we got inflation is proving to be sticky. There's just a lot of things brewing here in the pot that are coming to a head. And, we've been able to escape it for, I think, 2023 with Yellen's efforts on the T-bill side of things to pump this market one more time. What do they have else to use to pump the markets? That's pretty much it. T-bills, you can infuse a lot, but you can only do that for about a year. And then you have to go back to your normal issuance, which is long-term debt, and long-term debt pulls money out of the market. So there's your catalyst for going into the back half of the year. I'm sure they're going to try to push that into the election. But post-election, I'm like super worried because, coast is clear. Whoever is in for the next 4 years. And because they have to get back to the reality of debt structure for the government debt. And this cannot continue. And so while you can push it into the election to get your agenda done, once you're past that point, you really don't have a lot of incentive to risk more T-bill issuance at the risk of defaulting, because these guys have to pay that interest payment. And it gets to the point where it's inescapable. You won't be able to pay it because now you're behind the curve. It's almost like Bitcoin mining. When you don't have enough hash power to start, you never get ahead. It's similar in that, where the compounding effect of getting behind your interest payments continues. So you have to stop at the T-bills. You have to issue that long-term debt. And I think we really get and feel the effects of that post-election, Bob.
Yeah, it's super inflationary because, the banks will be overwhelmed, private investors will be overwhelmed. Foreign governments are not buying the T-bills, so you're left with the Federal Reserve doing it. And when they do it, that's pumping hot money into a system that's already too hot, if you will, in terms of cost structure. So we're definitely, that thing where do we want to hit the rocks or we want to go into the whirlpool? So I think we're in trouble. And the other thing too, sorry for a long video today, guys, but I didn't know this. United Kingdom also fell into recession this week. So now you have Japan officially in recession, United Kingdom officially in recession. I've been saying we've been in recession now for months. They'll get to us. And so I think we're all kind of taking on water here. And I think it's going to be, of course, it's going to be a surprise to everybody when it happens, except for us. And we just want to share this with you guys, manage your portfolios because you're not going to get the dip to buy back if it falls. You need to be able to protect yourself.
Yeah, I think the key level here at this point is the previous all-time high, because what we've done is we've broken out of that, right? So you get an initial breakout, which moves quite a bit. That's what we're seeing now. We have a seasonal window to pull back as we've been pounding the table on. What we do after that is extremely important, because I think if we fall back under that previous all-time high that we broke over earlier this year, you got to be careful. You got to watch out, because that's going to basically pull you back into that range below. And essentially all these buyers up here get trapped, right? It's a classic bull trap. So that to me is a hugely important level. And I think one that you need to keep an eye on. So pull up that S&P 500 chart, look at that last high we made going into 2022, mark that, because if we start to trade under that, that should be a huge red flag for you guys. And of course, we'll walk you through what to do as we enter that zone. But I think that really kicks things off to the downside.
Great. Hey, thanks, Phil. A long weekend, so we'll be back at you Tuesday with more videos. So give comments what you want to hear from us about. A lot of content now coming at us. I mean, we probably could do a whole week's worth of show here in just what's coming out, economic reports and research papers. Things are getting real. So we have a lot of good content for you guys. Hit like, subscribe, tell your friends. We'll see you guys later.
Trade Genius.